Good afternoon, everyone. So let's proceed with our next panel, which will be focusing on what is really the ROI, the return on investment that investors are looking for. And today with us, we have four people that are very much working either in the investment sector per se, or otherwise working with investors and with MedTech, digital health startups, supporting them to raise such investment. So I will start by actually asking each and every one of you to proceed with a very short introduction of yourself so that we have a better idea of the side of the fence that you are mainly working on and what's, let's say, the main angle that you bring to the discussion. And then we'll go through a couple of rounds. Shall we start with you? Yes, Giovanni.
My name is Giovanni Lauricella, and I live in Miami, Florida. I'm the managing partner of Lifeblood Capital. Fundamentally, we are a recruitment firm that solely specializes in medical device startups. We build teams from end to end around the world, in addition to having a fairly robust investor network that we help facilitate the startups to the investors. Roughly over the past 4 years, we've helped facilitate around 300 million, and we're now raising a $50 million fund in 2023.
I'm Julia Prakapovich, and now I'm founder of Interface Fund, but my journey in healthcare started from childhood. I'm a daughter of doctors, and I founded a healthcare company called 𝐂𝐨𝐦𝐬𝐴 Therapeutic, a data science platform for women menopause that was acquired by Seed Health. And I was a partner at �W𝐿𝐿, which is a growth stage fund for the past 3 years prior to founding Interface Fund.
Awesome.
Shamik?
I'm Shamik. I work at Octopus Ventures. Octopus Ventures is a pan-European fund focused on B2B software, fintech, deep tech, consumer and health tech. We invest anywhere between £1 to £10 million, and we have around 2 billion under management and invest 250 million every year through an evergreen fund. At Octopus, we're a B Corp, meaning we put impact and ESG at the heart of everything we do, even in our investments. And yeah, typical sizes of check range between £1 to £10 million.
Thank you.
Hi, I'm Cristiano Fontana. I'm the CEO at Free Bridges. We're a consulting company helping MedTech, 100% focus MedTech, early stage, from strategic advisory all the way from fundraising, go-to-market, market access, and M&A. I've been in MedTech for almost 20 years now in commercializations. My background is more corporate finance, so that's why we do fundraising. But I've been commercializing many different products, introducing in many different territories, covering all the clinical areas, and did my own startup back in 2009. So also, I know the struggle going through startup fundraising and that kind of stuff. So happy to be here.
Happy to have you here. And from my end, Anamaria, Magri, Pantea. I'm the founder of AscendConsulting. I'm based in Malta, and the perspective that I very much bring to this panel is that of public funders. EU funding, national funding, especially in the area of research, development, innovation, even more so in the in missions linked to health and the medical field. There is a lot of support. I typically work on the side of the funders, but often I work also with researchers and companies that are applying for that. So I think between us, we'll definitely be able to cover different angles and different aspects. Good. So let's kick the ball rolling. And I would suggest to go into a bit of, let's say, chronology of fundraising. So I will start with you, Julia, because I remember you were saying that at Interface Fund, you have this sweet spot in the pre-seed stage. So what are investors really looking at pre-fundraising at that stage in startups? What do they expect to see? What do they want to see?
I would say pre-seed from venture capital perspective in healthcare is not really different from any other pre-seed. There are 3 pillars that we consider to be very important. First of all, of course, it's a product and market. And it's pretty much predefined because the venture capital, we do a lot of homework in order to define ourselves where we want to invest. And that's our job on behalf of our investors as well. So we know what we're looking for. But when it comes, we look, so second pillar would be team. Team is very important, especially if you have just product and not any sort of market validation or any other metrics. And by team, I don't mean we look at certain brands in your CV or certain years of a certain background. Apparently, we look at how you'll be able to sell to your, not just investors, but your team, not just to your customers, investors, but your team, because you always have to sell your product and sell your idea to everyone you are, every single stakeholder that's around you. We also look at how team is able to be very agile and how it can be very flexible, whether you need to pivot sometimes, and how resilient they are, how good they are in terms of like actually creating the company itself. So it's not just about healthcare, it's about the whole ability to actually create company, lead company, go through tough times, be quite resilient. So it's more about personality of founders rather than background. And the third is, so we look at managing certain risks. So when we look at companies in our pre-seed stage, we look for signs to be ready, scientific risk ready to be mitigated. So there are certain different sectors that you may look at, but if the deepest science we go into, we don't find research projects. We have to find mitigated scientific risk already, and that could go. We can take engineering risk, commercial risk. We can take team risk, but science already have to be predefined.
So generally, if it would be like speaking in a technology readiness level, it would be somewhere at around 5, 6, or
TRL.
Yes, TRL level.
Like the phases.
Or you wouldn't.
Well, it really depends on what sort of technology you're in. It could be like software, right? It could be
or other technologies in the MedTech.
Yeah, everything. But it's like, I would say we invest in a lot of companies who are university spin-offs. Okay. So they have an idea, they have a tag, they are coming from the university. We have to have like scientific research, so we have to have some sort of prototype of what they're doing already. Okay. They may not necessarily have a 100% ready product, especially if they're in MedTech space and they still have to go through manufacturing, predefine what the final prototype should look like. But they already have to have some sort of proof, enough data for us.
At least the proof of concept is there.
Yeah.
Okay, good. Thank you. What about at Octopus Ventures? I know that you are much more spread across the entire life cycle of fundraising. In a post-investment phase, what are you looking at that point, especially when we start sort of looking also into this ROI? Do you start, measuring specifically certain aspects? How do you go about it?
Yeah, so I think it really depends on the stage of company you're investing at. So whether you're seed, Series A, Series B, all of those like metrics differ.
Say seed.
But
now
seed,
they
right,
got the first one.
So I think at that point, probably the most important thing that we look to measure is just execution. And that is just simply, you've now done the hard part of fundraising, but the second hardest part comes into play, which is proving that all that you said you'd do pre-fundraising, you're actually doing post. So we really look at, similar to what Julia mentioned, so team, tech, traction, but all of that comes into play with how well you execute. So I think without the execution piece, your return on investment just wouldn't come through.
What kind of timelines do you look for, or you are very concerned with, both in terms of execution and then the return on investment?
Yeah, so I guess you can break it up into different milestones. So inevitably, most venture funds invest for the long term. So we'd probably look to exit in 8 to 10 years of investing into a company. But in a shorter term, between rounds, so between your seed and Series A or your Series A and Series B, we'd expect to see enough traction or enough execution whereby the value of the company goes up 2 or 3x at each point. So wherever you can prove that out, and whatever you do, whether it's building out more team members or hiring more people, or whether it's focusing on tech and product, and really developing, a solid health tech business. All of that plays into part in the short term as to how you actually start looking at that return on investment, because again, varies in the short term. In the long run, ideally each fund wants to invest in businesses that can return the fund or reach $1 billion, but inevitably it's the shorter to medium term ROIs which we look at as well.
Okay. Thank you. Cristiano, you were also mentioning that at your company, you actually came up with a very particular approach to early stage valuation. And when we talk about ROI, obviously that is always benchmarked with the starting point and with the valuation. But at an early stage, it's very difficult to actually peg on something. How do you go about it? How do investors go about really assessing the value and then seeing how the ROI compares to that particular value?
Yeah, so echoing what Shamik was saying, of course, institutional investors, they're looking for a certain type of ROI. So when you approach valuation, especially in the early stage, you do that for mainly doing an exercise rather than just come up with a number that these guys will accept, because they're gonna price your company based on their ROI that they're looking at. So what we really do is what we did is let's say a novel approach for early stage valuation in MedTech that combines all the different aspects, like from the clinical standpoint to the industrial to the financial to the statistics. So we do a lot of simulations. But in reality, what really gives to the early stage startups is more an exercise to get them better prepared, to get in front of the investors. And it depends on what kind of investor they're talking to, like institutional rather than business angels, rather than family offices. They can leverage the price that they can sell their company at a certain round. So the point is, what you're really looking at when you try to do your valuation in an early stage as an entrepreneur, right? So it's not like I just want to get a number. It's more challenging your business plan, it's challenging all the project, and many times it happened that we actually ended up changing the project or just changing the business plan because companies realized that it was not the right one. But at the end of the process, what it really is about getting to investors and talking and address better their questions, so that can lead to a better price.
A more informed discussion.
Yeah, exactly.
And you would always guide them, I assume, to have a proper range so that you peg a bit your discussion and you anchor it into something, but then it's about negotiation and understanding what you offer, what they are looking for, how they see your company.
Truly, meaning there's not a number, it's always a range, and it depends also, valuation is about what is the potential of a company. Then the price that company will set their own stocks or whatever, it's also about the negotiation perspective, which means what kind of governance rights, what kind of veto rights they're giving. So the same amount of round compared to the same valuation really can differ in terms of what kind of condition you're giving to the investors. Mm-hmm. So the most important things I would say is split between valuation, which is what I can tell this company may value and can produce the ROI that investor can look at, compared to price, which is actually what it, at the end will get for your company. That's two different stories.
I think this is a very pertinent point to make the distinction between the value versus the price, and also that you as an entrepreneur, you would also possibly pay the price yourself in terms of veto rights and other rights that you provide in your company for that investment that you are getting. So it's a two-way street there, and everything has a value. Okay. Giovanni, coming back to you, and we heard that both Julia and Shamik talking about the importance of teams. And at Lifeblood Capital, you are definitely talking about, bringing and helping startups to to build even better those teams. How do you go about it to make sure that the teams that you are putting together are in line with what also the investors are asking or expecting before, after, linked to milestones? How do you go about it?
So it's definitely linked to milestones, especially as the company continues to develop. Early on, and I work with a lot of very early stage founders, they're looking to put a face on a slide, for example, when they're going to pitch to the investors. Because oftentimes, especially if the backgrounds are not aligned with growing the business further, the investors say, hey, you guys have something great, but are you guys the ones that are going to be executing? And so there's wonderful stories of founders who didn't have the business practice or whatever it may be, who has taken a company public or has exited one, but it's very rare. There's usually some sort of shift in CEO or shift or expansion in management team along the way, obviously in the expansion. But a lot of what I have to do is right around the seed level, and I'm talking medical devices here. It's what is the management team looking like to properly get to institutional funding, like Series A? What does that really need to be in terms of regulatory milestones, R&D, design freeze, for example? Do you have a CTO? Are you really the one that's going to be able to lead a team? We have a huge thing that we say, we call them the believers, right? So like when you're out there and you're a founder of a company and you're pitching to an investor, who are you getting up every single day on your team? Like who are your believers that are getting up and actually working with you? And that's what the investors want to see. If you're part-time and you're still a physician, if you're part-time working in another company, why are you instilling trust into someone giving you a check for 1 million, 5 million, 10 million when you still have another job? It's too easy for you to quit, or it's too easy for you to give up or not put that money to work. So a lot of what we need to find early on is the founders the right team to attract other talent to come on their team, to put the money to work if they can get it. And then other times it's a chicken and an egg where they need the money to be able to get the talent. And sometimes what they're hearing from the investors are they need the talent in order to get the money. So how do you solve that? It's a very tricky situation. It's very circumstantial.
So on a case-by-case basis, there isn't like a bit of a hard and fast rule?
It's not a hard and fast rule. I would say a little trick that has helped oftentimes, especially for early stage founders, is if you don't have the cash to buy the talent, you may have the equity to bring on independent board members, advisory board members, clinical advisory board members that give credibility to your company, but also give you insights that you could potentially execute without having to give cash, but you pay a little bit of equity. So it's all about traction in order to sell a story to these guys so that they give you money. If you yourself are capable of executing on that traction, but you just need the insights from someone who can help you out, that may be a strategy to get further along enough to be able to get money from these guys so that you can properly build out a team of professionals or experts or engineers, whatever you may need, that can actually help you get to the next milestone from a human capital perspective.
One thing that it's always, at the back of my mind is how, even when we talk now about investors, clearly up to now we talked a lot about this expectation of financial return. Obviously, everyone would be expecting a financial return and a good time financial return multiplied for the money that they put in. In the same time, at least the public funders that I work a lot with are clearly looking for that, but looking beyond that. And we are talking about, the public funders are looking at the patient outcomes, they are looking at cost savings, they are looking at making the life of the doctors in the hospitals easier, especially when we talk about health tech and digital health and so on, applications. And also are looking a lot at making sure that are reducing the load on the healthcare system through the different solutions, the different technologies, especially e-health and so on and so forth. So there are so many other things. And with this in mind, I'm wondering from a consultant perspective, when you work with startups that are pitching to different type of funding providers, investors in terms of equity investors or public funding providers, how much do you guide the startups to tweak or adjust their business case, project, investment case to fit the requirements of the investors. Is that something that you advise them to, or it's more like you have your sort of, investment case and just choose the investors according to this? How do you go about it? And I'm seeing both Giovanni and Cristiano at least. Go ahead, guys, go, any of you. We have about 3.5 minutes left.
So you said, I would say both, like we are in Malta, right? So I would say both. I always guide, it's one of the most important things to understand is, there are a couple of things, so let me step back. The first one is understanding your project, what kind of fit it can have in terms of stage that it is toward the right investors. So you need to understand the fit. You need to, propose it to the right type of investor. The second thing is, once you're proposing that, so once you're pitching that, you need to really understand the business model of who you're pitching to. So when you're talking with, institutional investors, you need to know what kind of ROI they're looking at, what kind of potential they're looking at, because your storytelling needs to change according to the type of investor that you're talking at. So you need to do your own work, absolutely. But before that, you need to understand whether your project has a fit for the different type of investor at the different type of stages. That's the most important thing, because the first thing that I usually assess is, okay, this technology at this moment should look at, for this amount, should look at those type of investor, and then your storytelling comes along with that. So
choose appropriately according to your life cycle.
Yeah. You need to tell investor how they're gonna make their money.
And that's where probably also the public funding is usually covering the gap in the early stages.
It can be an accelerator. It can be just a bridge to a different phase where other investor can be more attracted by your
of course, crowding in.
Yeah, why not?
Crowding in. Giovanni, you were also having an opinion clearly on this.
Yeah. To make it simple, very simple in general, early stage founders especially, they don't realize that there's basically two camps or two styles of major investor. You have your friends and family, you have your angel investors, you have your family offices. Let's call them emotional impact investors, very general. And then you have your institutional funds. They look at very different metrics, right? If you're raising a seed or a Series A for a medical device maybe, and you're going to family offices, if the father of that family office died of a heart attack and you're building a heart failure device,
they get sensitive to it.
First and foremost, if they give you $1 million and you return to them $7 million and they have $1 billion family fund, I don't want to say they don't care, but their $7 million of that $5 million that you make them is not going to move their needle. They're giving you $1 million because it's impactful. When you talk to institutional investors, they're investing other people's money. They have metrics that they have to look at. So it's a very different story that you're telling or selling when you're going out to an impactful investor or to one that has to abide by metrics in order to return the fund that they raised. And those are the two main things that I would say. You can go into details crazily, but those are the two main packs.
So your fundamentals are there, but then you need to obviously to plan according to where you are and also to what the investor is looking for.
The main thing real quickly is, like, I see it a lot in medical devices when they go from seed or seed plus, and they're going to go raise their first institutional round at Series A. And I look at all these slide decks, and all these founders are pitching a very family office or angel story. It's very science first. Here's my patient history. This is my emotional connection with the technology. My mother had this, and this is why I developed the device. Not this almost sterile business plan that they need to follow, adhering to regulatory milestones. What are you planning on accomplishing in month 3, month 9, which is institutional storytelling.
Yeah. Thank you so much. I think we are running out of time, right? Just to close it off, especially Julia, Shamik, are there some last comments that you would like to close off with?
Yeah, probably. I totally agree with two different group of investors, and coming from institutional side, I would say like pre-seed is very strategic and very, coming from operational background, it's very strategic. So we look at long-term strategy, short execution. When we come to like post-seed Series A, we start to think more financially. So we look at financial metrics. So I would just advise anyone who fundraising just to make sure that you know exactly what this group of investors are focused, like the venture capital or family office you're targeting, what they're looking for, what their KPIs, what they want to see first.
I think Giovanni hit it on the head in terms of the disparity or the differences between the two types of investors. But I really think that we now live in a world where both impact and outsized returns are not mutually exclusive anymore, and it shouldn't be in any way. So I think really defining what your business proposition is and whether you need VC money is a question you need to ask yourself. But then also outside of that, yes, you want to have your outsized returns for your institutional investors, but you also want to focus on other metrics as well. So whether it's impact, ESG, or even clinical outcomes as well. So I guess building up a comprehensive, authentic, value add to investors is just as important as just focusing on monetary outcomes.
Thank you very much, guys. Much appreciated, and I'm sure you will be available if there will be any other questions from the audience. Thank you so much.